Well, yet another earnings conversation. Let me bring on board the Managing Director and CEO of LIC Housing Finance. We have Mr. Tribuwan Adhikari joining us. Good morning, Mr. Adhikari. This is Harsh here. I want to quickly, sir, first start off by understanding how margins are going to evolve in this extremely volatile repo rate environment. Just take us through what has happened in Q4. What happens if there is no rate cut going forward, and what happens if there is? What action on the yield side, and how does that impact margins and spreads?
Well, yes, right now the margin scenario is pretty volatile. Yes, we've had 2 rate cuts in February and in April. Anticipating another one in the June MPC. Going forward, of course, we'll have to look what the signals direct us to. If I talk of Q4 last year, as far as liquidity was concerned, especially towards the latter end of February and March, there was a lot of liquidity crunch in the market, and as a result, it impacted our borrowings in the sense we could not get funds at the rates we were anticipating. So there was a lot of competition for the funds, and cost of borrowing did go up. From the lending perspective, the rates were constant last year. Yes, we did take a call in the month of February. We increased our PLR by 10 basis points because the cost of borrowing did go up. Subsequently, after the rate cuts in April, we've taken a 25 basis cut across the board in the PLR. Going forward, very difficult to say what it is going to be because, yes, rate cuts are impending. Repo rates would come down. From the borrowing front, 55% of my borrowings are at a fixed rate, 45% are repo rate linked. So any downsizing in the repo rate would impact 45% of my borrowing book. The remaining 55% is fixed. So situation is volatile, very difficult to predict what it would be. Would like to wait for the first quarter to really come out with a guidance or an indication as to where we would end up in the current year. On a personal front, I feel the rates we are right now at 2.72. The NIMs are at 2.72 for the company. I believe we would be in that range more or less, right? We'll have to be very, I would say, aggressive in ensuring that we get good borrowing rates, yes, from the banks as well as the open market through NCDs. And as regards our lending rates, we would have to take a call based on how our borrowing rates are impacted.
Okay, sir.
We've already taken, yeah.
Okay, sir. Sir, let me try and break this up a little bit better. Let me first start off. So you've given us a 55-45 split on fixed versus floating on your borrowing side, which is on your liability side. How does your asset side shape up in terms of fixed versus floating?
Asset is 99% floating.
Correct. So then likely shouldn't margins contract versus the 2.7% you've done this year?
Well, the indications do point to that. Right? But if I am able to manage my borrowing so that the impact of the rate cuts are compensated by lower borrowing costs, I believe I could make up for the lower lending rates through lower borrowing costs. So I feel at the most probably guidance, of course it will be very early to give a guidance right now, but anyway between 2.6 to 2.8 is the guidance I would like to give.
Point taken. And sir, what are you doing on the yields front? Prior to the rate cuts, you had given us commentary suggesting that you intended to hike your yields by around 10 basis points thereabouts. Is that intent still there, or does that change?
No, I don't think. See, we are in a very competitive market, right? Basically, I would not be sort of overshooting myself. Main competitors are banks because if you look at the HFC space and the NBFC space, most of them are into the affordable segment. We, as the biggest housing finance company, we are more into the IHL or the individual home loan segment. 85% of my book is in the individual housing loan segment, basically dealing with prime borrowers. So as far as the lending rates are concerned, I don't think I have too much of scope in my hands to keep them where they are, or on the other hand, to increase them is a definite no. I would have to stay aligned to the market conditions and see where my competitors are sort of placing their lending rates. But one thing we definitely need to do this year, and we've done it last year with some amount of success, is we need to diversify our lending. We need to move a little bit away from the individual home loan segment, which is a very competitive segment where the margins are not great, to the more margin accretive segments like I would say the construction finance or the project finance loan book, to the LRD and the LAP book. So that is what we've been trying to do. Last year, we've had some progress. Our project loans have grown by almost 47%, 47.5% to be precise. My LAP and the LRD book has almost grown by 20% as compared to a 5% growth in my IHL book, which makes up a major component of my lending book. So the focus this year, without losing sight of the individual housing loan, which is our bread and butter, we would like to diversify into these more margin accretive segments of NHI, NHC, what we call the LRDL and LAB book, as well as the project finance book.
All right, so earnings conversation taking you through what the results were for that NBFC.